Our next guest says to own AI and AI enablers like utilities. Joining us now is Ohsung Kwon, Chief Equity Strategist at Wells Fargo. And Ohsung, it's great to have you back here on set with us. Welcome.
Thanks for having me back.
All right, so what do you think of equities here? Because we've been hearing that valuations are very rich. And certainly it seems like there's a wall of worry for investors to climb.
Yeah, we're still bullish equities. We think the market's going higher. We're targeting 7,200 on the S&P by year-end next year. And if you think about the drivers of equities, we identify 4 drivers, which we call the PRISM model. So PRSM, profits, rates, sentiment, and macro.
And right now, just want to interrupt you real quick because we do have those Micron numbers. Christina Partsinevelos is ready with them. Christina.
We are seeing a beat on the top and bottom line, 303 adjusted, which is higher than the estimates on $11.32 billion. And this earnings beat comes when estimates had already increased because the company pre-announced just at the beginning of August. So these are even stronger numbers than expected. For their Q4 non-GAAP gross margins, 45.7%, also higher. For the guide, there was a lot going on in this guide, $3.75, I should say, adjusted for their Q1 EPS guide. That is higher than every estimate out there, according to street accounts. And then the Q1 revenue guide of $12.5 billion, also higher. And then the big one, too, is gross margins. They're guiding at 51.5. There was concerns that they'd be cutting prices, competition with Samsung, et cetera. And so that is why you're seeing shares up a little bit over 3.5% right now, teetering around there. Guys?
Christina, thanks. Sorry.
So let's go back to PRISM.
Yeah, so PRISM, PRSM, profits, rates, sentiment, and macro. The profit cycle is still very healthy. We're forecasting EPS growth of 11% this year and next, followed by another 12% growth in 2027. Rates, basically neutral, slightly positive. Sentiment is neutral as well. Macro is negative, but has been improving for the 4th straight month. So if we combine all those 4, we're still in a pretty healthy backdrop for the equity market. So we're forecasting about 9% annualized return for the next 12 months.
How much does AI continue to drive this? And we just got these Micron results, big beat across the board, stronger than expected guidance. After a strong pre-announcement, shares are higher. The name had already doubled before this report, and obviously we've been seeing this across the ecosystem.
Yeah, I think this is a AI-led bull market, and I think this is likely to continue. First of all, it's not a bubble. The entire outperformance of the NASDAQ since the end of tech bubble has been driven by better fundamentals in the NASDAQ versus the S&P 500. And I think that's likely to continue. Second, we still think we are in the early innings of the AI investment cycle. So if you look at tech equipment spend, so basically semis and hardware as percentage of total US GDP, it peaked at around 2.6% during the PC boom in the 1980s, 2.9% in 2000. Right now, it's only at 2.0%, which means that to get to that 2.9% in 2000, tech equipment spend has to grow by 47% on top of GDP growth, which is obviously very significant. And I think the way this plays out is, I think as long as the equity market continues to reward companies' CapEx outlook and the growth outlook, this is likely to continue. So if a hyperscaler comes out next earnings season and cuts CapEx outlook for whatever reason, I think the stock goes down. And if that's the case, companies are going to continue to invest in AI.
So what could go wrong? Clearly, you're bullish 7,200 by year end next year. There are some things, we could have some choppiness certainly in between. What could happen where you're going to have to rethink your thesis?
Yeah, I think AI CapEx is probably the single biggest risk to the equity market. We don't see that turning anytime soon. Like I said, I think this investment cycle continues. The other risk could be potential further slowdown in the economy. I think good news is good news right now for equities. I think further rate drop from here would be bearish for equities. That's essentially how we're positioned. So we're overweight AI, sort of market weight defensives, and we're actually underweight cyclicals.